What is going on, everybody? Welcome back to another episode of Money Mondays with Midas. Just got back from Florida, man. Went down there to go kick it with my brother, Phil Jones. Had a ball, man. You know, it's one thing to go down there as a tourist, but it's another to go down and go kick it, you know what I'm saying, with family that actually lives there and can show you Florida for real, you know. Seeing Florida from someone that lives there point of view versus a tourist point of view, two totally different worlds. Had a ball. I love both worlds for sure, but man, you know what I'm saying, it was really different to see it from pretty much a native standpoint. But today what I got for y'all is I have consumer staples. We're going to talk about consumer staples. I'm going to explain what that is and then what items are actually considered consumer staples right after the intro. Yo, let's go. All right, so the article that I got for y'all today, and as usual, it will be posted in the description, okay? This comes from the Motley. So, you rely on consumer staples every day. They include daily essentials such as food and beverages, personal care products, household and home care products such as paper goods, alcohol, tobacco, and cosmetics. You buy consumer staples regardless of the state of the economy. That is very true. And the amount you buy is relatively fixed in good times and bad times. In this way, the consumer staples sector behaves much differently than consumer discretionary businesses such as restaurants, hotels, and apparel, or consumer durables, which are longer lasting products such as furniture and electronics. This is very much true because think about it. Regardless, you know, we went through a certain situation, you know, the pandemic, and regardless, you were buying toilet paper, you were buying gas, you were buying, you know, paper plates, you were buying, you know, burger patties and ramen noodles and whatever have you. You were still buying that regardless, okay? Consumer staple companies may not have the highest earnings growth or year-over-year revenue growth because these stocks tend to be large, mature companies. Historically, the sector has experienced relatively little disruption, but these stocks make up for modest growth with low price volatility, reliable profits, dividends, and defense positioning. And that is what we're going to dive into today. We're going to dive into basically, you know, durable, reliable stocks. So, advantage of consumer staple stocks. Consumer staple stocks function in a non-cyclical manner, meaning they offer investors safety during recessionary climates. Like I said, you need toilet paper regardless. paper plates, paper towels, diapers, you need that stuff regardless. Since these companies sell goods such as food and cleaning products that consumers rely on regardless of the state of the economy, they tend to generate solid profits even in weak economies. For instance, a number of consumer staples companies thrive during the early stages of as consumers stocked up on essentials and avoided spending on discretionary purchases such as travel and restaurant meals. Okay? More recently, that spending has shifted back to discretionary categories, weighing on some consumer staple stocks such as Clorox, which had earlier benefited from the demand for cleaning products. So again, what are we using Clorox for? Some people use it for dishes. Some people use it for, most people use it for their whites, their clothes, stuff like that. So again, you can look at a consumer staple as something that, regardless of whatever the state the economy is in, it is a necessity to have. You absolutely cannot operate without it, period. Some consumer, I guess you can call them super. Consumer staple stocks are dividend achievers, companies that have increased their dividend payouts every year for the last 25 consecutive years. That is crazy. For this reason, consumer staple stocks are often popular with retirees. We talk about retirement a lot. Consumer staple stocks are often popular with retirees and other investors seeking long-term income and security. Many offer better dividend yields than the S&P 500. Exchange Traded Fund, which is EFT, which currently pays a dividend yield of roughly 1.5%. I'm actually finna verify that. Yeah. 1.54. Last month it was 1.66. And then last year it was at 1.69. So, yeah, 1.54. Because consumer staple companies operate in stable sectors and sell products that are always in demand, the biggest ones have been around for a century or more. That's what you want. Their longevity is a reflection of their brand value, a history of acquiring smaller brands, and their ability to endure a wide range of challenges and economic cycles. One important factor to monitor when looking at consumer staples company is its ability to pass on cost increases. Although this issue often takes center stage during inflationary periods, it is always an important component of growth. Simple price increases, changing packaging sizes, and production innovation are all vital tactics that get used. In inflationary periods, cost of ingredients, labor, and distribution often rise faster than the company's ability to pass on price changes. There can be a period of margin weakness that will likely be temporary for the best managed consumer staples companies. Price increases also need to be balanced against the risk of consumers trading down to cheaper alternatives. See, there's this nice balance that you got to play with, you know what I'm saying? Because you always want your your customers or your loyal customers, you always want them to look at your product. You always want them to go to your product first. You always want your product to be in your customer's mind. You don't want to raise the price so high that they're forced to go look at this more cost-effective brand. So it's a real nice balancing act that these companies have to play. And as far as like changing packages, sizes, and things of that nature, just look at your candy bars. The king size bar used to be this big. Now it's probably 1/3 that size, 1/4 that size for a king size. So you gotta look at stuff like that, or like the water bottles, the caps. The caps got smaller. The top part where you drink out of it, they shrunk it down a little bit to save on plastic and stuff like that. So these companies are smart, man. They definitely try to find ways to be able to, cut costs, but still be able to deliver, a nice, decent product to you, at a reasonable price. So the companies, inflation, as they mentioned a lot of times, mentioned throughout this article, it doesn't just affect us as the consumer. It also affects the company that has to produce that product, because they want you to still be a customer. All right. So Motley has given us a list of what we should buy. Just as you're familiar with many consumer staple products, you'll likely be familiar with many of the top stocks in the sector, such as Procter & Gamble, Pepsi, Estee Lauder, and Unilever. Now, if I'm not mistaken, and we're going to dive into the Robinhood after this, of course, but we already have Unilever, and I believe we have Pepsi. So we're definitely going to be adding Procter and Estee. So Procter & Gamble. Procter & Gamble is best known for its marquee brands such as Tide, Gillette, and Crest. So if you didn't know who owned those products, now you do. The household and personal care company is also 200 years old. That's a different conversation, but this is why I feel it's important to establish a brand, establish a company, and then not only establish a brand or company, but establish a brand or company that is a necessity, regardless of whatever the economy is going through. You live on forever. You may be gone, but your company's standing 200 years old. A large number of its brands hold the number 1 or number 2 market share position in their categories, including paper products, laundry detergent, diapers, like I said, and beauty products. P&G is also a dividend aristocrat. P&G is currently developing innovative products, including the non-toxic insect repellent Zevo. In 2019, it released a line of plant-based cleaning products called Homemade Simple. After streamlining its business by selling off non-core brands, restructuring, and cutting costs, P&G's position is as strong as ever. Like other consumer staples companies, P&G received a healthy boost from the I almost said it. You know how YouTube is. However, the company's results have continued to be strong, with organic sales, which exclude the effects of acquisitions and currency exchanges, up to 10% during the fiscal third quarter ending June 30th, 2022. Core earnings per share also rose 6%. Notably, the organic sales gain was driven by a mixture of higher volume price increases and selling more higher priced items. The company is hitting on all cylinders. All right, so that's Procter. Pepsi. Do I need to go into Pepsi? You guys know what Pepsi is, right? Okay. I will touch on this, okay? They also, besides Pepsi, they also own Frito-Lay's and Quaker, okay? They also own the famous drink brands Mountain Dew and Gatorade, okay? Big competitor to Coca-Cola. So, there you have it. I think where Pepsi also wins at is that they lock down a lot of restaurants. Like they're deep into the restaurant industry, you know. So a lot of restaurants that you go to, it's Pepsi products. So I don't think we got to dig that deep into Pepsi. Okay, Estee Lauder. All right, the cosmetics subsector tends to be more volatile than other parts of the consumer staples industry. That's because trends in the beauty business, which are subject to broader fashion tastes, tend to change more quickly and attract smaller brands. Additionally, cosmetic companies were hit harder by than most consumer staples businesses because social distancing led to a decline in the demand for makeup and fragrances. I don't know. I mean, I didn't put in that much study into it, but as far as I know, I still wanted to smell good. I don't wear makeup, but my cologne game was tougher than ever. Like, I still want to smell good. So, nonetheless, Estee Lauder has been a top performer, more than doubling the S&P 500's roughly 60% return over the past 5 years. Okay, let's go S&P. However, that includes a more dramatic accent and a much steeper decline during the 2022 bear market, highlighting the volatile nature of the sector. Estee Lauder is the second biggest pure-play cosmetics company in the world, behind, what's this, L'Oreal? And it has an impressive array of prestigious beauty brands, including Clinique, Vita, La Mer, and MAC. The company's recent growth has been driven in large part by a success in the Chinese market, where its skin and care products have performed particularly well. That said, recent efforts in China to contain the spread of have led the company to reduce its fiscal 2022 guidance. The drop was notable, taking organic sales growth between 5 and 7%, down from the previous guidance of 10 to 13%. Still, the stock is likely to be a good choice for investors looking for a mix of high growth and the stability of a traditional consumer staple stock, despite the near-term uncertainty related to the issues. So, despite the downward fall in cosmetics, this is still a banging company. That's what I heard. You know what I'm saying? At least that's what I read. This is still a banging company. You can't go wrong. All right, and Unilever. We already have Unilever in our portfolio. If you've been following me since the first Money Mondays all the way up to now, you already know that we got this in our portfolio. If you don't, if you want to add it, that's up to you. You don't have to. You know, you don't have to follow exactly what my portfolio looks like. It's up to you. This is one of them that I have. For investors who prefer to take a contrarian approach, Unilever is working on a business turnaround. The negatives here, which include the failure to consummate a high-profile acquisition, have left the shares with a historically high dividend yield of about 4.2%. What is most interesting, however, it is the activist investor Nelson Peltz, who was instrumental in turning Procter & Gamble's business around. has been added to Unilever's board of directors. Although there is unlikely to be a short-term fix in Unilever's problems, the company is already streamlining its business to increase the accountability of key leaders, something Peltz has suggested is necessary. And with iconic global brands such as Dove, Ben & Jerry's, Knorr, and Hellmann's, the company has a strong brand portfolio to lean on as it works to improve its growth profile. Long-term investors can happily collect a generous yield while waiting for Unilever's business performance to improve. So, again, that's one of the reasons we got in, because we have a higher percentage dividend yield, and we also have Nelson, for lack of better terms, cracking the whip. He's whipping it into shape, okay? So, I like ETFs. I think they're the best. That's just my opinion, because I don't necessarily have to do individualized or itemized buy-in. I can just go into an ETF and buy everything with a decent dividend yield, 1.5, 2, 3, whatever, and I'm straight. Okay, so I think the best 3 consumer, and they already put it on here, but I had already did the research before I actually found this article, and the same 3 that I found is in this article. So we have the Consumer Staples Select Fund, which is XLP. We also have the Vanguard Consumer Staples ETF, which is VDC. And then we also have the iShares US Consumer Goods ETF, which is IYK. Okay? Let's get into it. And you know what we about to do when I say it's time to get into it. We're finna move these dollars. But before we do that, I think our tree has cultivated enough. Put in a little bit more growing. And just like any plant, you got to give it time to grow. So with that being said, it is time to add next dollar. All right. So let's move these dollars. Let's get it. All right. So as usual, we're going to go into our normals. Okay. So here on this channel, our normals are going to be, our S&P, the VOO, our REITs, and it doesn't have to be my normal. It could be your normal. Okay. We got our VNQ. $2. All right. One sec. All right, next, we're going to go into our REM. $2. Bam. So REM is one of our REITs, okay? A REITs is your real estate investment fund, okay? This is kind of like the easiest way for you to get into the real estate game without actually having to physically own any real estate at all. You ain't got to cut the grass. You ain't got to put up no drywall. You ain't got to fix no toilets. You got to do none of that. Okay? You just buy into the REIT and just keep buying into the REIT. Let's go with our SPY. When you see that, just hit that underneath button that I hit, just Q fractional. It says Q fractional, and it'll take you through to allow you to proceed with that fractional purchase. Our VOO. And you don't have to put in $2. You can put in $1. See, look, $1. See where it says Q fractional order? Just click that. Swipe up. There it is. All right. Let's do our Berkshire Hathaway. Berkshire is up almost $3,000 today. Hold on, what did that say? A total return is 42 cents. Okay. So now what I want to do, we got our normals out of the way. So now what I want to do is start putting in on a few other stocks, and then we'll jump over to these other stocks. Okay. So let's go in on tops. $2 there. Yep. Okay. Cool. That's done. Let's go back in on Disney. I was in Florida. It makes sense. Let's buy our Disney. Our Microsoft. And like I said again, you don't have to follow exactly what I do, what I invest in, what my portfolio look like. You don't have to do any of this. You can do your own thing. You can follow your own thing. But if watching my channel helps you stay on top of, you know what I'm saying, making sure that you put in, making sure that you keep your investments rolling, by all means, I'm happy to do so. Let's go into our Mongo. Right. Now, when we came across our iHeart, I believe we bought 3 shares and at $3. See how minimal a lot of these companies are. You can own a lot of these companies with dollars, man. That's all it takes. So that's our normal stuff there. Let's go back in on our Adobe. Another $1 there. All right, we'll probably do a few more, and then we'll go ahead and jump over to this new stuff. So I'm feeling like Tesla for sure. Let's do NVIDIA and Rivian. NVIDIA are the computer chips, the graphic cards, stuff like that. So we're gonna go in on them. Rivian. All right, so we got a couple of dollars spent already. All right, so now let's go ahead and jump over to the consumer staples EFTs. All right, so how we gonna do that? You're finna go up here. Okay, the first one is called Consumer Staples Select Fund. Okay, that's XLP. Let's see if it pops up. XLP. Right there. Bam. Let's get in there. And how much did we own it for? Correct, $1. It was a very good guess. And so our next one that we're gonna look at, this one is called the Vanguard Consumer Staples ETF. Okay. This is VDC. Okay. Pop quiz. How much do we need to own it for? How much can we own this for? Correct class, $1. Right. And then our third one. This one is called the iShares US Consumer Goods ETF. IYK. All right, we in there, okay? Now, the article, going back to the article, one thing to note, all three of those brand new ETFs that we just added, okay, they have Procter & Gamble listed as their number one holding. That's their number one company within that ETF. So, definitely something good to know. All right. Another company I was looking at, and this is just a bonus, okay? It has nothing to do with any of this, okay? Another company I was looking at, this is just a bonus. MDC. believe that's pronounced Mondelez. Anyway, they too. Okay. They engage in the manufacture and marketing of snack food and beverage products. It operates through the following geographical segments: Latin America, Asia, Middle East, and Africa, Europe, and North America. It produces, its products include beverages, biscuits, chocolate. That was how I found them, because when I was looking up, number one chocolate companies or best chocolate stocks, they popped up. Started delving deeper. Gum and candy, cheese, and grocery and meals. Its brands include, but are not limited to, Nabisco. That's huge. Nabisco, Oreo, also huge. And Lou Biscuits, Cadbury. Those three right there are huge. They also do a gum, Trident. I didn't know this until I started looking up. I found this out through looking up, trying to find out about chocolate. Looking into chocolate. So this is definitely one that's going to get added to the portfolio. Market cap of 94 billion, okay? We got a dividend yield of 2.2. That's not bad. I'll take it. That was just a bonus one. It just happened to be food. But again, like I said, I found them trying to look up chocolate. And that's it, y'all. So I appreciate y'all rocking with me. We here every Monday, building our portfolio together. You know, the whole purpose of this particular segment is to show you guys that you can get involved, that you can start building your stock portfolio, that you can start owning these companies for just a buck. You know, a lot of us have zero information when it comes to, getting involved and buying stocks. Or, all they teach us is 401k, Roth IRAs, which are extremely fantastic. But that's as far as our knowledge extends to. So I want to show you guys that not only can you get in for minimal dollars, because I understand that, it can be hard. You hustling to get the rent, you hustling to make sure your kids are straight, you hustling to make sure the bills are straight, you hustling to make sure that your car is straight, and it may be overwhelming. What I'm trying to do is I'm trying to, package this and give it to you in as easy and as simple as possible, so that you understand that it doesn't have to be as complicated as you think it is, and it's not as expensive as you think it is. It's not expensive as you think it is. So I want to bring forth this information to show you guys, because we have lack thereof, when it comes to, finances and getting involved and trying to move our money around, and where should we put it and what should we invest in. And I decided to build this to help us. And I don't mean, just, us, but everybody that's interested in learning this information. I said, I'm keeping it real simple, okay? I'm not going above and beyond and giving you the super high tier, information and all that. I felt that I wanted to keep it on just a real basic, simple, get you guys in, show you what I'm doing, show them how I'm moving. This is a real portfolio. I actually cleared this out, sold off a bunch of stuff to start fresh. And, start building with you, start working with you and building with you, and let's grow together, grow our portfolio together. So this is what I got, I actually touched 2,000, I think it was last week. And I should have recorded then, but, I was on vacation. So I didn't really get an opportunity. I was out kicking it, spending time with my brother. I ain't seen him in a while, so I really wanted to invest a lot of time with kicking it with him, showing him love. And but here we are. I was up to 2,000. We slid back. But it's okay because, a lot of the market, you do see some greens there, but it's a lot of red here too. And it's like that across the whole board, honestly. So when you see stuff like that, man, don't freak out. Don't get into the mode of, oh, I gotta sell. Relax. It's cool. That's what it does. What goes down must come up. Period. All right. So I'ma holler at y'all next Monday. I'm your boy, Midas. Peace.